Welcome back to Financial Market Insights for Traders, the show where we unpack the tools, strategies, and mindsets that help you navigate today's financial markets with clarity and confidence. I'm your host, Sophia, and in today's episode, we're diving into a topic that is absolutely critical if you want your portfolio to not just survive, but actually thrive during turbulent times. We're talking about scenario analysis and stress testing. These two practices are often overlooked by retail investors, but they're the exact methods used by institutions, hedge funds, and seasoned traders to bulletproof their portfolios. If you've been wondering how to build an investment strategy for recession scenarios or how to structure a resilient bear market portfolio setup, this episode will give you the practical playbook you need. And as always, I'll be sharing tools and resources that make the process easier, including a cutting-edge trading platform and an investing podcast you'll definitely want to check out. So let's get started. What is scenario analysis? Think of scenario analysis as financial what-if planning. It's about taking your portfolio and modeling how it would behave under different sets of conditions. For example, what happens if inflation stays high for another 2 years? What happens if equity markets drop by 20%? How would your bond positions hold up if interest rates remain elevated? Now here's the key. Scenario analysis isn't about prediction, it's about preparation. No one knows exactly what will happen in the economy, but by running these scenarios, you can understand how vulnerable or how resilient your portfolio really is. Let's make it practical. Imagine you hold a tech-heavy portfolio filled with high-growth companies. If you run a scenario where valuations contract by 25%, you may find that your portfolio loses a third of its value. That's a red flag. On the other hand, if you hold a diversified portfolio with defensive stocks and some government bonds, your downside may look far more manageable. What is stress testing? Now, stress testing is the tougher sibling of scenario analysis. If scenario analysis is about testing reasonable possibilities, stress testing is about simulating extreme events. It's like a fire drill for your portfolio. We're talking about events like a 2008-style financial crisis with a 50% equity market crash, a sudden spike in oil prices due to geopolitical conflict, a pandemic-style shock where entire industries collapse overnight, or even a sovereign debt crisis that undermines the safety of government bonds. Why put yourself through that? Because stress testing reveals your portfolio's breaking points. It helps you answer critical questions. If markets crash tomorrow, could I survive without derailing my retirement? Could I still cover my mortgage or tuition payments? How much time would it take for my portfolio to recover? Stress testing isn't about doom and gloom, it's about resilience. You wouldn't drive a car without airbags, and you shouldn't run a portfolio without knowing how it holds up under stress. Why both tools matter: some investors dismiss these practices as too conservative or too theoretical. But here's the truth. Ignoring them is a costly mistake. Bull markets create a false sense of security. Everyone feels like a genius when prices rise, but it's during downturns that the real gaps show up. The benefits of running scenarios and stress tests are huge. You become aware of risks you didn't see before. You gain confidence in your decisions because you've already mapped out what could happen. You optimize your portfolio by making strategic adjustments instead of reacting blindly. And you stay calm in downturns because you're not surprised, you already have a plan. This is how professionals operate. It's not about avoiding losses altogether, it's about managing them intelligently. Building an investment strategy for recession scenarios, let's move from the abstract to the concrete. Suppose the economy tips into recession. Corporate earnings shrink, unemployment rises, consumer demand falls. That's not great news for equities overall. But recessions don't impact every sector the same way. Here's how you can prepare. First, tilt toward defensive sectors. Healthcare, utilities, and consumer staples remain in demand even when the economy slows. People don't stop buying medicine, electricity, or groceries. Increasing your allocation here provides natural protection. Second, emphasize quality and dividends. Companies with strong balance sheets, low debt, and reliable cash flows tend to hold up better. Dividend-paying stocks, in particular, give you income when growth is scarce. Third, balance with fixed income. Government bonds, especially U.S. Treasuries, typically rise during recessions as investors seek safety. Adding them to your portfolio provides ballast against equity losses. Fourth, maintain liquidity. Cash is boring in good times, but during a recession, it gives you options. It keeps you from being forced to sell at a loss and allows you to buy undervalued assets when others are panicking. Finally, add alternatives and hedges. Assets like gold, commodities, or managed futures often move differently than equities. They diversify returns and provide insurance against inflationary recessions. Together, these steps form a robust investment strategy for recession scenarios. You're not abandoning growth. You're just ensuring you can survive the downturn and be ready for the recovery. Building a bear market portfolio setup. Now, let's talk specifically about bear markets. These are extended periods when stocks fall 20% or more. Unlike short corrections, bear markets test investors' patience and discipline. Here are the principles for a smart bear market portfolio setup. 1. Cut speculation. Bear markets punish high-risk bets, whether it's meme stocks or speculative tech plays. Focus on quality. 2. Diversify intelligently. Add assets that don't move in sync with stocks. Think bonds, commodities, or certain hedge fund style ETFs. 3. Rebalance systematically. Markets overshoot both ways. Rebalancing allows you to trim assets that have held up well and reallocate into undervalued areas. 4. Prioritize capital preservation. In bear markets, your first goal isn't making money, it's avoiding catastrophic losses. Here's a practical allocation framework you can consider. 35 to 45% equities, tilted toward defensive and dividend-paying stocks. 25 to 35% fixed income, focusing on high-quality, short to medium-duration bonds. 15 to 20% alternatives, like gold, REITs, or low-correlation ETFs. 10 to 15% cash, ready to deploy when markets stabilize. This setup won't eliminate losses entirely, but it reduces volatility and accelerates recovery. The key is to stay flexible, protect your downside, and keep dry powder for future opportunities. How technology helps running all these scenarios manually would be overwhelming. That's where technology steps in. One platform I highly recommend is the Crystal Ball Markets platform. It's a world-class, cutting-edge, user-friendly trading platform app designed to make scenario analysis and stress testing simple and effective. With this tool, you can simulate rising interest rates, sudden market crashes, or inflation shocks and see exactly how your portfolio would react. The insights are clear, actionable, and tailored to real-world decisions. Check out the Crystal Ball Markets platform today and take your risk management to the next level. The role of education, but tools alone aren't enough. You need the right mindset and knowledge to design realistic scenarios. That's where education comes in. If you're looking for beginner-friendly, practical content on trading, investing, macroeconomics, and financial markets, I strongly recommend the Crystal Ball Markets podcast. It breaks down complex concepts in an accessible way and helps you think strategically instead of emotionally. Tune in to the Crystal Ball Markets podcast and build your financial knowledge base. Common mistakes to avoid even when investors attempt scenario analysis and stress testing. There are pitfalls to avoid. Number 1, overcomplication. Don't drown yourself in dozens of scenarios. Focus on the few that are most relevant to your goals. Number 2, anchoring on history. The next crisis won't look exactly like the last one. Use history as a guide, but always account for new risks. Number 3, ignoring liquidity. A stress test might show you can handle losses on paper, but if you don't have cash when you need it, you're still in trouble. Number 4, failing to act. Insights are useless unless they lead to actual portfolio adjustments. And number 5, overconfidence in so-called safe assets. Even bonds or gold can behave unpredictably under stress. That's why diversification is non-negotiable. The bottom line, markets will always cycle between expansion and contraction. You can't predict exactly when the next downturn will hit, but you can prepare. Scenario analysis and stress testing aren't luxuries. They're essential practices for protecting wealth and building resilience. By creating a thoughtful investment strategy for recession scenarios and structuring a smart bear market portfolio setup, you give yourself a crucial edge. And don't forget, you don't have to do it all on your own. The Crystal Ball Markets platform gives you the tools to run simulations and stress tests with ease, while the Crystal Ball Markets podcast builds the knowledge foundation to interpret those results effectively. Prepared investors don't just survive downturns, they turn them into opportunities. And that's the real edge in this game. That's it for today's episode of Financial Market Insights for Traders. I'm your host, Sophia. If you found this helpful, make sure to subscribe, share it with a fellow trader or investor, and don't forget to check out the links in the show notes. Until next time, trade smart, stay prepared, and keep building for the long term.